Broadcasting from Baltimore, Maryland, and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here is your host, Dan Ferris.
Hello and welcome to another episode of the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value. That's a value investing service published by Stansberry Research. We have a great show lined up. Can't wait to get to the interview guests today. Let's get to the rant. Lots happening right now. Okay, give you a little peek behind the scenes here. We record this deal usually on Tuesday or Wednesday, and we publish it usually on Thursday. So as I sit here on a Tuesday, the stock market crashed just about 3% yesterday on Monday. So, I feel like there's no way I can ignore that. There's no way I can just sit here and talk about mistakes investors make or, Howard Marks memo or one of the usual things I talk about without addressing this. Okay, so let's just think about this a little bit. Because I know a lot of people, the market crashes 3% and, they're in their portfolio 9, 10, 20, 30 times that day, and they're thinking they need to do something. Overwhelming majority of the time, that's a mistake. So let's just take a step back and think about this a little bit. As I said, the market was down like 2.9% yesterday. I just call it 3%. And between, Trump's new Chinese tariffs and China devaluing their currency, you can read all about that stuff in the newspaper. The stock market is actually about 6% below its July 31 all-time high close. And it's about 6% below 1 week ago, the prior week's Monday. So it's 3% one-day move, 6% one-week move, thereabouts. And I started thinking, well, this doesn't seem terribly unusual to me, but it certainly doesn't happen all the time. And I looked at S&P 500 closing price data on Bloomberg back to January 1 of 1990. Now, the S&P 500 has had 247 one-day moves of more than 2.5% in either direction. That's what I looked for, more than 2.5% in either direction since January 1990. So that's about 3.5% of the time. It's fairly rare. It's not a regular occurrence. So if you believe that it's not a regular occurrence, you're right. And as for the 1 week moves, right, the 5 trading session moves of more than 5%, I looked for those. 5-day moves of more than 5% in either direction. That happens roughly 2.8% of the time. So even less often. So these aren't regular occurrences, but they're not big numbers. I mean, I've been telling you that we're within 1% or whatever of the most overvalued moment in history. So if you're 3% or 6% below that, not a big change in things, right? It's not a big change. I mean, it's a big change in the value of the Chinese yuan. I mean, that thing was it was down around 6 to the dollar not too long ago. I want to say maybe a few years ago, 3-4 years ago. And now it's 7 to the dollar. Boom, just like that, over a few years. I mean, it's a pretty healthy move. It was down there pretty good not too, last year, I want to say 6.7 or 8. And so it's a pretty healthy move for a currency. But, the stock market move, it's a small move, but it happened in a very, very short period of time. So it scares the hell out of everybody. It certainly doesn't mean we're in a bear market or that you should be selling stocks or anything like that. Bear market is usually defined as a 20% drop from the highs. So by that definition, based on closing prices, we won't be in a bear market until the S&P 500 closes below 2,420.69. That's another 15% south of here. I mean, it's unlikely to happen, period, though we know, it must happen eventually, right? Because it always does eventually. So, take all this with a grain of salt. It's not the most statistically rigorous analysis, just trying to get a handle on this for you. And as I said, stocks have not gotten much more attractive because of this move. After Monday's close, the S&P 500 traded at about 2.1 times sales, which historically is still very expensive. I mean, the highest, most expensive moment was January 2018. I think it was January 26th, if I'm not mistaken, at 2.36 times sales, which just eclipsed March 2000. I think it was March 31, 2000, at around 2.34 times sales. So, those are like the all-time peaks price to sales on S&P 500. And here we are, 2.1. And the bottom in December 2018, December 24th, that big bottom was 1.8 times sales. And, I don't know what the average is because it's not meaningful. If you look at a chart of price to sales, it's up and it's down and it's up and it's down. And it's hardly ever like sideways for very long. So an average I think would be deceptive. But, I wouldn't probably start saying the stock market wasn't overvalued until it stayed certainly below 2 for a while. And, probably more like, 1.5 or less. And below 1 is like, fire sale. Buy. So we're not there yet. Okay, we're 6% below the most expensive moment in history. Bargains are not coming out of the woodwork. But I couldn't help noticing a couple of things on Monday. Obviously, if you read my newsletter, Extreme Value, or like, any one of like a half a dozen other Stansberry newsletters, we've been long gold and gold stocks, and they did their job on Monday. Some of them were up. One of the ones I recommended was up about 10%, and gold itself was up, I think about 1.4%, which is a really nice move in gold, which makes sense. When people are screwing with currencies, people buy gold. It just makes perfect sense. And gold is still a no-brainer in my opinion. Overall, I don't think you need, having taken all this into account now with gold and stocks and whatever, I don't think you need to do anything terribly differently. As long as you maintain a long-term value-oriented perspective, you're probably not going to make any big mistakes. And even if you're not a value investor, we talked with Matt McCall last week, and he is a long-term investor, like long-term investor. He rides through bear markets. He knows what he's doing. And he has a great track record. He's got tons of triple-digit winners and tons of quadruple-digit winners, more than 1,000%, which is awesome. And so, you maintain your long-term perspective, and that gets you through a lot. I mean, stuff like this week is noise, right? It's nothing to a guy like that. So, whether you succeed or fail will not ever be in proportion to how active you get when the market takes a 3% one-day dump or a 6% 1 week, drop. That is not how you behave during that time. Actually is in direct proportion to how successful you be, but the right behavior is usually nothing, doing nothing, certainly nothing different, and overall, all the same stuff still applies. The more you trade, the poorer you'll wind up. The less you trade, as long as you're fairly conservative, long-term oriented, know how to identify a good business and not overpay, as long as you keep doing all that stuff, over the long term, you're going to do pretty well. None of this changes the fact that, you should still avoid like really risky like biotechs and startups and, IPOs that trade at 50 times sales when they have no profits and no intellectual property or competitive advantage of any kind that makes them special. You should still avoid risky little exploration mining stocks unless you really know what you're doing. All the same stuff applies. The risk is in all the same places. And of course, the main place is your behavior, thinking that you need to do something. It just feels like you need to do something. Well, guess what? You don't. You don't need to do anything different if you already have a strategy and a plan. The degree to which you think you needed to do something on Monday is the degree to which you probably don't know what you're doing and are in over your head. You're out of your depth. You are operating outside your circle of competence. We talked about that several episodes ago, and I've gotten lots of emails, thanking me for talking about it. People are appreciative of this idea. I think it's a very good one. Warren Buffett uses it all the time. right? Don't go outside your circle of competence. And unfortunately, being in the stock market puts a lot of people there, okay? If you think anything's different because of what happened Monday or what happened over the past week, it may be. We could be in a bear market, but we don't know. And, taking a single week's action like that, this happens like 3% of the time, these sort of things. So, when they happen, you're like, oh, that happened. Okay, well, that happens about 3% of the time. What's for lunch today? There's just nothing to really discuss based on that alone. Now, if you're some kind of macro trader and, you think knowing all about the Chinese yuan is important, that takes work. That takes time. Nobody's going to talk to you for 5 minutes on a podcast and you're going to go, oh, Chinese yuan, I'm an expert. I'm going to go trade based on that. No, it's not going to happen. So I would say don't do anything different. I've consistently recommended the same actions, so maybe I'll repeat those one more time. I've consistently said for the past, really, I started getting concerned in May of 2017. It's just started feeling very toppy and speculative to me at that time. And, the market's up. That call has basically, it continues to be caution. I hesitate to say I'm completely wrong because the conditions haven't changed much. Stocks are still really, really expensive. And, the caution is still warranted, in my opinion. And I didn't say stocks are going to crash tomorrow. I've never said that. I don't say that kind of stuff. I don't do that. I don't make, short-term predictions about market direction. I think it's a fool's errand. But for me, I just look at the valuations of businesses and I think, do I want to own this at this price? And a lot of the time under these circumstances, I wind up saying no. So that's really, I'm still there. It's been that. I've been there for 2 years and I'm still there. And I've said, hold plenty of cash, which you will wind up doing if you are selling overvalued businesses and not able to find new replacements. Buy some gold. And if you say, well, isn't gold's come up? It's 14, it hit 1475, I think, late Monday on one chart that I saw. And then as I talk to you, it's in the 1460s. So, it's come up quite a bit. I've been talking about it since it was certainly in the 1300s, maybe even high 12s. Doesn't that mean it's more expensive now? Well, technically speaking, yes, but you have to understand the nature of gold. This is not a business. It's not a cash-generating business that has an intrinsic value based on all the future cash flow you're going to get out of it. It is essentially a currency. And you put money into gold, you take it out of dollars. And it's generally been a good thing to do that late in the stock market cycle, late in the economic cycle. And gold got murdered, down from the heights of 2011 to the depths of late 2015, early 2016. And it's still closer to those depths than it is to the former heights. It's actually about halfway between, somewhere, almost halfway between, I think. So, still a good idea to own gold. I think it's going to eventually make a new all-time high over the old all-time high of 1,900 an ounce set back in 2011. I think we're looking at a long-term bull market in gold. I think holding gold, and I personally hold more silver bullion than anything. Those are great ideas, and none of that has changed. And it doesn't change necessarily with the, these little moves from, whatever it was, say 1,200 to 1,460, call it. That doesn't change any. The proposition is still the same. It's still late in the cycle. You still want to get some money out of dollars and into gold. That's so don't get, if you're a trader, then we're not, we're having a totally different conversation than that. That's a totally different conversation. There's no valuation of gold when you're trading it. There's price action and momentum. Totally different. And I don't care about any of those things. I care about the fundamental case for getting gold out of dollars late in the cycle. Boom, period, done. That's it. So that's where I am. And that's where I'm probably going to stay for a while. Hold plenty of cash. Don't buy garbage and don't buy anything that's overvalued. Buy value where and when you find it. We have another new pick this month in Extreme Value that we're writing up, and it'll be out this Friday. And that's where we are. Don't do anything different. I hope that doesn't disappoint you. I hope it actually, is like lifting weights and helps you steel yourself against making portfolio mistakes, okay? Because that's really the big thing you need to do. You don't need to be a genius. You need to avoid stupidity, right? That's what Charlie Munger has said famously, but other people have said it too, because it's very true. It's very wise. Investing is like tennis. Professional people, they can win by being great at it. But the rest of us duffers, or I don't know what they call hackers, is that what they call people who hack around at tennis courts and, just amateurs, we play a loser's game. And the loser's game is just don't be stupid and don't make mistakes. Because, the studies show, the Dalbar study, DALBAR, you can look it up, it's called the QAIB study. It shows that, like, investing, most people, they end up worse than they started. Investing is a net, loss for a lot of them. Or at least they dramatically underperform the market, so the gain isn't worth the effort. And, it's an emotional nightmare for most people. Okay, so I hope this helps. That's the rant. If you like it, don't like it, think it's worthless or stupid or whatever, send your politely worded criticism to feedback@investorhour.com. There's a lot new in the world. Let's get to that right now. There's a lot that's new. It feels new, doesn't it? When the market falls 6% in a week, it just feels like a new world. So, one thing that's new, of course, is that the Chinese have devalued their currency. And before that, the return of Tariff Man, our President Trump, slapped a 10% tariff on $300 billion in Chinese goods on top of $250 billion already covered by tariffs. My view on tariffs is like, shooting yourself in the foot doesn't help you run faster, so I don't really get it. And that's all I have to say about that. Other things going on in the world. Berkshire Hathaway, Warren Buffett's company, their profits fell, but they're sitting on like this record giant cash pile, $122 billion. And this is like one of Buffett's trademarks, right? They buy back shares, but they don't pay dividends. And they just accumulate cash under the presumption that he will be able to deploy it at some future time. He's in his 80s now. I mean, I hope he'll be around. I wish him well and hope he'll be around for a long time, and I hope he will be able to deploy some of it. But, if he doesn't, at some point, somewhere along the way, let's say the thing is trading at north of 2 times book value or something like that, which I doubt it's worth much more than that in terms of intrinsic value. But at some point, it gets a little irresponsible to hang on to cash. I don't think they're there yet, but at some point it does get that way. We'll see. We'll see what happens. They've built a huge stake. It's worth about $50 billion in Apple. And it's funny that he owns that, because of all the big technology companies, like, that's the one whose business sort of kind of makes me scratch my head. I mean, 2/3 of the revenue come from the iPhone. How many iPhones can you sell before the world gets enough of you? And I understand there are other businesses. I've made this point before. There are other businesses, but they're not big enough now to quickly, they're not growing fast enough, even though they may be growing quite fast, to replace, if Apple lost some significant chunk of that 2/3 of revenue. So I don't know. He's Warren Buffett, he knows more about this stuff than I do. So he must believe in that product. He must believe in the iPhone. You can't own the stock without believing that the iPhone revenue will not cave in. And I don't think that's a no-brainer proposition at all. And of course, he bought back $2 billion worth of his own shares this year. That's great. His marker goes up. First it was 10% above book value. Then it was 20% above book value. And I think it might have been briefly 30% above book value, but I can't really remember that one. It doesn't matter. It's just, he's raised the threshold constantly. And now I think it's like discretionary. I don't think he's got this limit anymore. And they say, well, it's below intrinsic value. Okay, well, what's intrinsic value? And he never tells us. He tells people how to value the company, though, which is a lot more than other people tell. So, he's not doing anything irresponsible, but his goalposts have moved over time. He used to say that, the best way to value the overall stock market was to look at total market cap to GDP, which is way over 100% these days. I think it's like 130% or somewhere in that crazy neighborhood, maybe even higher. And so, by that, the market is kind of expensive. It's really expensive. But then he came out a couple of years ago and said, well, as long as interest rates are low, stocks are a good deal, which is really kind of a flabby way of looking at it. You'll be right until you're disastrously wrong, I think, if interest rates are your benchmark, because they move around. They float around. Central banks manipulate them. And even if they did manipulate them, cycles happen, right? So anyway, Berkshire, it's been a great company. It's an incredible bet. It's I think it's like 2,000x since he took over, or 2,500x, some huge number like that. But next comes, what do I have here? I have luxury movie theater chain iPic files Chapter 11 bankruptcy. Of course, this is not a huge surprise, right? Company filed bankruptcy in Delaware, might sell itself. And this is less than 2 years after its IPO. Florida-based company, chain of theaters, owes about $205 million under secured credit line, owes $15 million to various vendors and suppliers, the trade creditors, they call them, and other like unsecured creditors. And they lost about $57 million last year because, you can stay home and buy a big screen TV and order a pizza, and you can, pause the thing when you need to go to the bathroom and stuff. It's hard to compete with that. Not a big surprise. Here's an interesting thought. There's this headline from Barron's, and the article suggests that Ferrari, the Ferrari company, the Ferrari stock is worth 12 times more than Tesla. Interesting comparison because, Ferraris are cars that work, and a lot of people like them, and Teslas are having troubles, and presumably Ferrari makes money and Tesla does not. Ferrari just went from a buy to a hold, though, according to this one Societe Generale, SocGen analyst. He increased the price by almost 30% to $183 a share. They increased their target price. So I'm sorry, they must have gone from a hold to a buy. They increased their target price by 30%. So they like Ferrari, they don't like Tesla, and they've observed what I think is patently obvious, what I hope most people, and this is the point that I want to get to about Ferrari. Ferrari is not a car company, right? It's a luxury goods company. So it shouldn't trade like, another car company. It should trade like a luxury goods company, because that really is what it is. I mean, they're expensive luxury goods. You're not buying fancy purses and jewelry here. Although some jewelry is more expensive than Ferraris, I guess. A little bit of it, I guess. But the point is, I want to say something about this, because you need to understand what business you're truly in. Are you truly in, what business is Tesla truly in? Because they've, Elon Musk has been all over the map. He said, we're into batteries and we're into solar panels and we make electric cars and we're changing the world. And it's really kind of airy-fairy. You can't nail him down sometimes on it. And WeWork is that way. WeWork, this company that basically rents out office space, they have this very sort of idealistic sounding thing, when really what they are is a company that just pays way too much for office space and thinks that, losing money doing that is a good business. So, but Ferrari is different. Ferrari makes money selling luxury goods, not cars, and should trade that way, and, maybe is worth 30% more. Okay. That's really, those are really the items that kind of caught my eye that I wanted to say something to you about. And right now I want to get to this interview because, man, this guy is awesome, and I'm so glad he agreed to be with us this week. All right, finally, time for our interview. I've been looking forward to this one. Today's guest is Marc Cohodes. Marc is a former general partner of Rocker Partners and Copper River from 1985 to 2009. He began his career at the Northern Trust Company in 1982 after graduating Babson College with a BS in finance. He's been profiled in the books Reckless Endangerment, Selling America Short, The Most Dangerous Trade. He was the subject of a Harvard Business School case study on his efforts to expose mortgage fraud at Novastar and accounting chicanery at Signet. He was named one of the Power List 25 movers and shakers we're buzzing about in 2017 by the Financial Post. He resides in, I don't know this, Cotati, California, where he runs Alder Lane Farm. Marc Cohodes, welcome to the program, sir. Thank you for being here.
Thanks for having me, Dan.
So, Marc, folks who have been in your profession of, managing money and making big bets and all that, I always like to ask them, when did you first have an inkling that this was your destiny, that this was your vocation?
Well, I think when I was a sophomore or a junior in high school, which was about 1977, which is a long time ago, we were taking a class called the Econ. It was an economics class, and the head of the teacher, a guy named Dennis Sullivan, decided to start an investment fund, raise money from parents, and invest it. We didn't know jack shit. He picked me to run investments. And I think it was at a time when oil was moving, gold was moving, and the Chicago Midwest Options Exchange was going, CBOE was just going. And we actually luckily made an awful lot of money in something called Houston Oil and Gas. I'll never forget that one. So I said, this is a lot of fun. This is fascinating and something I want to do. So that was back when I was 16 or 17. I'm 59 now. So a lot has changed since, a lot of ups, a lot of downs, but that's what got me kicked into this whole mess.
So high school, huh?
High school. Yeah, high school.
So before we talk about any more financial stuff, I actually want to know more about how you got into this Alder Lane Farm. Why a farm?
Well, that's an easy one. So back in the early 2000s, my daughter was interested in horses, and I bought a dilapidated horse farm, fixed it up. And in the mid 2000s, my ex-wife got my ex-house in Marin, California, and I took the farm and love living here, love running it, have some chickens, have a bunch of fruit. We have a few horses. And that's kind of that. I couldn't see living anywhere else. It's very peaceful. We're, 50 miles north of San Francisco. Get into the city as much or as little as we want. And that's kind of that. It's I'm not the easiest thing to live with. So that's why a lot of people in this business tend to have ex-wives or multiple ex-wives, but it is what it is. But I love my existence here.
It sounds idyllic.
Well, it's lovely. And I think I have 200 fruit trees. I have chickens, but I have fewer of those. The coyotes have done in a few chickens. And I try to lead a balanced existence, which isn't always easy, but that's at least the attempt.
Well, that seems like a good spot to attempt it. Does the farm make money? Is it a thriving operation, or you don't really care so much about that? You just like being there?
I think what I make in my left hand, I put back into the farm in the right hand. So at the end of the day, I think it's about a break-even thing, but the place looks nice. It's painted, and the footing is good for the horses, and the chickens are happy. And being in business or being in agriculture in Northern California is very difficult. So whenever anyone bitches about the price of food or how expensive things are, try growing stuff. It's very hard, but I don't really lose, but it's a great place and a great place to live.
Okay, so do I have this right? You stopped managing other people's money in 2008 and have not done so since?
Yes, that is correct. I've had an awful lot of opportunities to do so, but I think I've been quoted in some spots that when you short stocks, it's essentially you age in dog years. So there's not many 59-year-old short sellers around who are active in this. But there's something clearly wrong with me that I still sort of enjoy doing this and haven't blown off my arms or other body parts. But I'm hardest on myself. And the one thing I couldn't stand when I was in the fund business is letting people down, disappointing them, losing people money, and even worse, taking shit for it. So I enjoy the path that I'm on, and wish anyone doing this professionally, especially shorting stocks, nothing but the best.
Yeah. So since 2008, you've been active though, right? You just manage your own money and not others, but you've been quite active during that time.
That's correct. I've been more active, I would say, in the last 5 years, in that whole, whatever you want to call it, from 2009 to kind of 2013, 14, call it the melt up, if you will. It was, things were completely unnavigable from as I saw things, but things are at least now are a little more topsy-turvy, where you have sort of a chance. You still don't have much of a chance, but at least you have a sporting chance of doing okay on the short side, considering we've been in a bull market for what people say 10, 11 years, something like that.
So I read an article where you said in order to do it, short selling, you were talking about, you have to be 9/10 insane. So I guess my question from that is, what has to go wrong in your life that you pursue a career as a short seller? Like why that path?
I always say, you're born with this. No one would remotely ever go to a school, yet alone a good school, and come out and want to do this. It's just, I used to say that short sellers are frustrated or former high school newspaper editors, which I was one, and frustrated financial reformers. It's a combination of that, and there's too much righteous in you, where you see things that are wrong and you want to fix it, and you sort of see things that others don't. And sadly, I can't help myself. I mean, I see things a certain way, and I try to be different, and I try to be more long, or try to ignore a lot of stuff that I'm seeing, but I just can't. I mean, there's too much. I can't stand when people get ripped off, especially seniors. I can't stand seeing working class people getting ripped off in subprime, whether it's timeshares, mortgages, car loans, get rich quick schemes. I just can't stand it. I can't stand seeing veterans being injected with horrible medicine, being used as guinea pigs. I can't stand seeing people, made promises of things that are just fairy dust. I just can't stand it. It just gets me going. And once you get going, it's very hard to stop. It's very hard to shut it off. It's very hard to shut off the outrage to what's going on. So that's sort of a problem. I was going back and forth with a guy named Alex Berenson, who's written a book about marijuana, how the negative effects of it are quite bad. And 15 years ago, when he was at the New York Times writing, he wrote a lot about Taser, and I helped him with that. And I just remember Taser used to brag that Taser saves lives. That in cops, instead of using guns, if you use a Taser, it saves people's lives, which is just complete bullshit. And the stock got destroyed at the time. You can't put voltage into someone, whether they're on drugs or maybe unhealthy. You kill them. And I think they killed an awful lot of people. And if you need to use a gun and you need to use force, that's what a gun's for. But something in between just puts everyone in a bad spot. So I was going down memory lane on Taser with Berenson the other day, and you jog my memory on some of this stuff. And I remember on my email, I used to have the signature thing, Taser saves lives, because it's just so ridiculously bizarre and insane. It doesn't save lives, it kills people. So it's kind of a long way around the question.
No, actually, you raise an interesting issue for me, which is it seems like this goes in cycles too, where financial products purported to be, safe or high quality or, AAA or whatever, are really toxic waste. They're really garbage. So, when you say something is less lethal, that I think they used to call Taser less lethal, it's more dangerous because it kills people, and you're telling me that it doesn't kill people. And I feel like a lot of financial products are the same way. And maybe a guy like you might agree with that, no?
Well, not only do I agree with it, it just goes along the line. I mean, it's the same thing with timeshares. I mean, timeshare companies rope people into buying these things, saying how cheap it is to buy a vacation property. But when you add back in the interest expense, the maintenance fees, the various things these companies charge you, it ends up costing you far more. And the problem is you can't sell them if you want to sell them. It's worse than owning a boat. I don't own a boat, but you read and know and see anecdotal stories from talking to people, interviewing people. It's terrible what these timeshares do. And a lot of it is to seniors and taking advantage of their retirement. And it's terrible, payday lending. I mean, I think I used to be involved in this World Acceptance, which just used to rip off very poor people in the Southeast who didn't know any better, and people sign up for these loans and they just get taken to the cleaners, and it's just terrible. It's terrible to take advantage of financially unsophisticated people. And the backside of that is when you speak out, you then become the target of what I would call trolls and all these people who need to keep these schemes and frauds and what have you going, which, it gets very stale. I mean, my Twitter is @AlderlaneEggs, and I'm fairly active on Twitter exposing things. And I use Twitter really to get contacts. I speak out on things, and there's a lot of people who lurk and people who see what I have to say, appreciate what I have to say, and they chime in. They direct message me or email me with further information, which helps the cause. But the amount of hate I get from it is incredible. I mean, I have over 5,000 people blocked just because it's ridiculous. People would rather, folks like me not speak out or not be around. So I work hard to make sure that doesn't happen. I work hard to keep moving the needle to expose some of this stuff. But it's wide open out there. There's a lot of it going on.
Yeah, nobody's keeping you from speaking out, that's for sure.
They try real hard. I mean, they have gone overtime to try to shut me up. But so far it hasn't worked. And mentally, I was talking to my wife about it. It's very hard. I mean, there's this company that I was involved in. I'm still involved, and I'm not short that much now because I was on an interview with Grant Williams at Real Vision, who I'm speaking with at your guys' conference, which should be fascinating. He said, "Why don't you just cover some of your mimetic short and just speak out on the thing so people don't assume that you're after this thing for money?" So I took his advice. I covered, I think, 90 some odd % of my position, and I speak out and I keep going on mimetics. And now people accuse me of being obsessed. So if I'm short the stock, they say I'm doing it for money. If I'm not short the stock, they say I'm obsessed. And it has nothing to do with obsession. It has to do with seeing something through, and it has to do with exposing criminal activity and wrongdoing and fraud from Medicare, VA, billing, FDA.
But Mark, there's something a bit more for you, though, isn't there? Because haven't you said that anybody who doesn't take investing personally is wrong? I mean, it's I've seen some of these tweets. There's a personal aspect for you in this.
That's an excellent question. Not a question. It's an excellent point you make, and I bring this up all the time. Whenever someone says they don't take it personally, I would never want a dime of my or your listeners' money with that person. Because if you're entrusted to manage someone's money, let alone your own, you should take it personally. You should take it not only personally, you should take it beyond serious. And I take it personally when crackpots, threaten to kill me. I take it personally when a CEO of a company bribes a U.S. Senator, in this case, Johnny Isaacson, to have the FBI come by my house with guns and tell me to quit tweeting about Mr. Petit, like Mr. Petit works for the U.S. government. I take that personally. And others should take it personally, and others should be outraged. And I take it personally when my friends are hassled. And there's this lack of, outrage out there of what's really going on. And people, I think that if it's not happening to you, it's just not happening, and it's okay. But none of it's okay. And whether or not you believe in global warming, who knows? But it's kind of like global warming happens gradually, and your right to free speech and your right to speak out and your right to speak truth to power is just slowly eroded over time, to the point where if you're forced to shut up and they're forced to silence you and you give up, I think the war is lost. So yeah, I take it personally. I take it very personally. I have a disabled son. He's 32. He lives on the property, has his own house. But I take it personally when people threaten to kill him. I take it personally when people say, "Who's going to take care of the kid when his father's dead?" I mean, that's if that's how trolls play, they bring out the best and or worst in me. So that's the downside or backside of what goes on. And your listeners are probably saying, why does this guy do this? And I'm not going to be doing it, that much longer, but just important to see things through, in my mind.
Yeah, I just want our listeners to know that Marc is talking about Parker Petit, the former CEO of MyMedics, one of his biggest shorts, which he has called the biggest fraud he's ever seen. It's still the biggest fraud you've ever seen, MyMedics? By
far. I mean, people, the guys who own the stock try to mock me on it, but I have such evidence of, even ongoing fraud at MyMedics. It's fascinating. My lawyer has all sorts of stuff. I've been sent tapes. Georgia's a one-way consenting state. There's all sorts of audio recordings out there of criminal activity that's ongoing at MyMedics as we speak, even though they've claimed they've replaced everyone. And it's something. The thing that's fascinating is that the SEC's been in there for quite some time. The DOJ's in there. They admit to lying to the FDA. OIG of the VA, OIG of the DOD's after them. But nothing's happened yet. Everyone thinks it's fine because nothing's happened, and things take time. And if something doesn't happen, it'll be a sad state of affairs, because these guys have offered companies the playbook of how to commit security fraud, accounting fraud, how to pull one over on the FDA and things like that. And if it's allowed to go on, it'd be quite a shame. But, I said the same thing when I was working on exposing Insys, which is that fentanyl drug that everyone now talks about, and some of this opioid stuff. But, if more people were speaking out about this stuff long ago, not that the crisis would have been averted, but it could have been nipped in the bud a lot sooner than it otherwise has been. And that's the sad part of it, is that people say, what's in it for me, or why speak out? Or, if you speak out, you'll get sued. What do you stand to gain from it? Government's slow. It's not your problem. Things like that. And, it's sad to me, because society and people used to try to prevent really bad things from happening. And that's part of the role, to me, of a short seller, is exposing wrongdoing. I mean, I never, ever shorted a stock because it's too high. I'm not interested in shorting Amazon or Netflix or Costco or anything that's legitimate doing well just because it's too high. I don't know what 90% of these companies even do. But these bad guys need to be stopped. And they know they're doing wrong, and they hire lawyers and they hire lobbyists and they bribe politicians to shut guys like me up. So got to keep trying to make sure it doesn't happen. But it's a tough fight. It is a tough fight.
Yeah, it just sounds insane for anybody, but a very, very few highly unusual, highly driven individuals.
Exactly. I also say, don't try this at home. I just, I don't have Facebook. I don't have Instagram. I'm not interested in anything like that. But on Twitter, I say, don't try this at home. But I, try to at least entertain some people with what's actually going on. And it's real. It seems surreal, but it's actually real.
So we talked a little bit about, so we've mentioned MyMedics. That's one that I feel like you're just like more famous for that than anything else. What about Overstock? You've been after this guy for a long, long time, and you still are, aren't you?
Well, I used to be short Overstock, and then we smoked the peace pipe a couple of years ago, and I went long Overstock because I thought, change was at hand. And I don't know, I bought the stock at 15. I spoke about it at grants at 30. I said I liked it because I thought retail was worth more, and I was excited about their blockchain and T0 initiative. Stock went to 90. Byrne, who I like and I respect, hasn't executed, and the stock went from 90 to 10. Now it's back to, let's just call it 22 or something like that. But they have an inordinate amount of things going for them, but they just haven't executed. And I was on something with Hedgeye a couple of weeks ago, and they asked me about it. I think it was 14 or 15. Someone said, you still like Overstock? I said, yeah, I like it a lot. But if it was run by someone who's either user-friendly or Wall Street-friendly, or someone who could execute properly, the stock would be a whole lot higher. So, it's the lesson to me, and I keep learning even though I'm old, is, visionaries running companies, they can really only take things so far, that you need, people running companies who can flat out execute, which is, the modern day issue with Tesla. I mean, you can say whatever you want about Musk, whether he's a visionary or not, but he sure has not been able to execute. And one day that's going to come back and bite those guys in the butt, but who knows when.
Mark, the idea of all people going long one of your previous shorts, I mean, have you ever done that before? That strikes me as highly unusual, as something that is probably highly unusual for you.
So let's say I started doing this professionally. I started working at the Northern Trust Company in 1982. I've done it with Canandaigua Wine, which is now Constellation Brands. I made it on both sides plenty big. I've done it with Datascope, short then long. We made on that very big both times. I've done it on Activision with Bobby Kotick, short it then long it. And I've done it with Cree when Cindy Merrill was the CFO there. I mean, there's quite a story there. Made plenty on the short and long and Overstock. So I think I've done this probably half dozen times over 1982, 37 years. So, God, I've been doing this in 37 years. So, I've done it six, seven times. So, yeah, it's highly unusual.
Okay, well, that's more than I would have thought.
Yeah, but if my thing would be is if you know something pretty well and you know what's wrong with it, you should be able to figure out what's right with it. But a lot of these companies, when they get really sick, they don't get better. They get really sick. I mean, we used to be short toy companies and toy distributors, and this can't be yogurt and restaurant chains. By and large, most of the stuff I get involved with over time, these companies go out of business. Technology changes or management failures or things go bad and you can't get up from failure. But the guys who I've done it with Casey's General Stores too. So that's another time. I mean, we used to be short every convenience store stock known to man when the EPA came in and said, you guys are polluting the groundwater, and they all had huge underground tank liability, and it put a lot of them under. And I ended up getting to be pals with Don Lamberti, who ran Casey's. And I think the stock went 30 to 6 and recovered. And I think we were the second largest shareholder in Casey's next to him. And the sad part is we sold the stock at 22. Now I think same shares, it's about 160. So I could have owned like the entire state of Iowa and Minnesota if we just stayed long Casey's, but I sold it. But if you know something as a short seller and you've done your work, you know what makes the thing sick, you should also know what can make it better. So, but again, I've been through an awful lot in life, and my mind isn't quite what it used to be. I have more savvy because I'm older and more experienced, but I'm not what I was at 30 or 40. That's for sure. But it's been done. I can still swing that bat if need be.
Well, I'll tell you why I thought that was probably not something that you would have done, because we'd never talked before, so we don't really know each other. And I've heard that to you, the jockey is kind of more important than the horse, and you look for people that you kind of don't like, or you think they're up to something, possibly criminal or at least unethical. And you even have followed them. Like you look at a previous company where they may have worked and saw the bad things that happened there, and then you look at the next company where they work and maybe you go short that one. But that's obviously not always the case.
That's for sure. But something on Canandaigua Wine, which is now a big company, it's Constellation Brands. So back when Canandaigua used to be in the wine cooler business, and the guy who ran it, a guy named Marvin Sands, an older fellow, I thought he was great. But his son, Richard Sands, was running wine cooler, and he was spending money just like a drunk. He was spending money trying to compete with Seagram's and Gallo, which was Bartles and James at the time. And I said to myself, these guys aren't making money in this, and they're growing top line at like 70%. I said, when wine cooler slows, and wine cooler will slow because it was a fad. I thought that at the time, and it turned out to be true. These guys are going to lose their ass, and they have debt, so it could get to be a mess. So Canandaigua stock, and it traded on the Amex. I don't even know if there's an Amex anymore. American Stock Exchange. Canandaigua stock was 37. We were short it. We covered the thing at 12 on bad news. Goes to 9 on worse news. And I call up Marvin, and I am 27 at the time, 26, 27. And I call up Marvin, and I say, Marvin, your son is going to run this business into the ground. And best I can tell, if you got out a wine cooler, you probably make $1.50 a share. And we talked about it, and he said, you're right. And he shuts down wine cooler. He stops spending. It's a true story. And stock's now 5. And Fidelity, who was the biggest holder, portfolio manager gets fired, Neil Miller, probably because he bought the stock at 30. So Fidelity, through a broker, and again, this is in the 80s, calls up and says, we know you guys are interested in Canandaigua Wine. We have 2.3 million shares for sale. And the stock used to trade 10,000 shares a day. And we're like thinking, what the? So I call Marvin Sands and say, Marvin, Neil Miller wants to sell, because he's been fired, 2.3 million shares. Do you have any thoughts whatsoever? And Marvin says, I will buy every share myself. And I'm thinking, holy hell. I said, holy hell. We say, not so fast. We'll take some. So we bought a bunch. And at that time, then we owned 9.9% of it. And then Marvin bought some. And some of your guys should look back at the chart of what Canandaigua was done since the late 80s to now. I think it's up 400 or 500%. It's up 400 or 500 times. Forget percent. It's now a huge company. And Richard and I, we haven't spoken in a while, but he ended up learning from his dad on not to spend or spend crazy. And they've turned this thing into a, billion dollar enterprise. I mean, they're Corona beer, they're everything in liquor right now. Beer, wine, spirits. I think they're in marijuana, the whole bit. But that's a true story, and that's what really happened. And they weren't frauds. They were just operating things poorly. And sometimes, you can hide in broad daylight and see that something's very different, or you can make a change. I guess people now would call it activism. There was just looking at their model and saying, if you guys stop spending, get out of this business, your base business is pretty good. I mean, Marvin used to tell me the highest cost part of a bottle of wine or spirits or Mogan David or Manischewitz or whatever they sold was the glass. I mean, think about that. I mean, if you're buying a bottle of a Canandaigua product, if your highest cost is the bottle, you're making a shit pot full of money in the stuff that's going in the bottle and the raw material. So really, it's a good business if it's run properly, and they decided to run it properly. And again, I mean, I think we own stock at 3, 4, 5, 6, 7, 8, 9. And, we sold it at 30, 40, 50, 60. We made a fortune, but I could have owned the great state of New York had we held on to it, but it's not really my bailiwick or core competency, holding on to longs for generations. So that's like on Barron's.
I'm just looking at a chart here in Bloomberg real quick on Constellation, which is actually the biggest winner I've ever had in my newsletter. And the low on December, the data goes back to 1986. The low on December 30th, 1988 was 42 cents. And the high was 228.
Yeah. That's about right. That was the day of that print. And, I've done all right for my son. And I think at the time, I put all his money in this thing. And, again, I sold it way too early. But when he was born in 87, I think, God, it makes me feel old. He's 32 and I'm 59, and we're talking about Canandaigua wine. And it used to be CDG.A. Then it turned into Wine A over the counter, and now it's STZ. But it's something. The late Marvin Sands would be very proud of his boys, Richard and Robert. But man, oh man, you're making me feel old with this long, short discussion. But
well, I'm 57. I know how you feel. So we're getting near the end of our time here, Mark. I was wondering, I usually like to ask someone like you who's, been around the block a few times, if you could leave our listeners with one thought, what might that be today?
I've said in the past, and totally believe it and live by it, that the average person spends more time reading a restaurant review or figuring out where they want to go for dinner than researching their stocks or mutual fund or whatever they're in. I think it's very important for people to understand what they're in and why they're in it. What can go right, what can go wrong. Because in my mind, unless you really understand what you're in this chaotic time, you can get swung around by what's preached to you or scared to you or hyped to you on the Cartoon Network, aka CNBC. I think it's very important you know what you own, because CNBC is the government's infomercial on why to buy stocks, and especially, garbagey things. And I think it's beyond unwatchable. I joke on my Twitter, I watch roller derby reruns, the rifleman reruns, honeymooner refunds before I'll watch CNBC. And too many people are sold stocks with folks having a general understanding of what and why they're in it. And I think if you know why you're in it, what you own, what can go right, what can go wrong, I think everyone would be much better off. Shorting stocks is a dangerous game. I recommend it to nobody. But understand, it's important to understand what the negative case is. Don't shoot the messenger of the negative case, but try to understand the message. And if the message starts to reverberate as true, you're best to get the hell out, because bad things can happen. And I don't like seeing innocent people lose money. I enjoy criminals losing money, and I enjoy bad operators losing money, but not innocent people, not people who subscribe to your stuff. So that's probably what I'd leave people with today.
Well, thank you for that, Mark, and thanks for joining us. Yeah, it makes a lot of sense. I think it's a great message.
Yeah, and look forward to seeing you in Vegas in October, right? October, that's when that shindig is?
It sure is. You'll see me there.
Okay.
Absolutely.
I'll be there with the incomparable Grant Williams.
Yeah, I'm looking forward to that. Love Grant. And I look forward to seeing what you guys come up with, and it'll be nice to shake your hand.
Okay, man. Well, thanks for having me. And if anyone has any scoop, I'm at Alderlane Eggs on Twitter. So that's my venue of communication.
All right. Thanks very much, Mark. And, maybe we'll have you back again sometime.
Look forward to it. Thanks for having me.
Okay. Bye-bye. Thank you. Okay. It's time for the mailbag. This is a very important part of the show. It's where you and I can actually have a conversation. I say stuff to you. You write in your feedback to me. I answer back to you. It's fun. We get to know each other a little bit. You can send any questions or comments or politely worded criticisms to feedback@investorhour.com. I read every single one of them, and, I try to respond to as many as possible. So this week it was kind of light in the mailbag, so I only have 2 of them. The first one is from Brian B. And Brian B has some nice things to say about the show. Brian B says, love the Stansberry podcast. Ever since its first iteration with Porter, I learned something each week and usually find your guest interesting and informative. And then he said, speaking of signs of the top, this week's guest, and then he's got this quote. He's got quotes around this thing. Our guest, he's talking about Matt McCall from last week. And he says, the quote says, hey, I flunked out of 5 colleges, blew my money on sport gambling, then blew more money on stocks in the tech bubble burst. Let me manage your money. In other words, he's trying to characterize our guest, Matt, as having said something like that. Then he says, nice work if you can get it and stay out of bankruptcy court and or jail. Then he goes on and says, I do have a question concerning something I came across in the finance industry press/blogosphere, the concept of selling at a target price. I do not understand the concept of picking a specific price for a stock, then selling it once it attains that price, irrespective of the company's fundamentals or the stock's technical performance. I do understand using stop losses or holding a stock based on one's fundamental analysis of a company and one's projection of how that company will perform in the future. Can you help? Cheers, Brian B. 2 things, Brian B. First, I think you're wrong about our guest, Matt McCall. I think you're really wrong. That guy did something unusual. He has become a serious long-term investor who knows how to hold on to a business, which is what you should do. That's what equity is for. It's for holding on to. You invest the capital, you hold on, and you're buying all those future cash flows. And few people have done it as well as he has. He learned from his, whatever you said, sport gambling and losing money in the tech bubble. He learned from those things, and he has a pretty impressive track record. So I think you're completely wrong of him. Matt is not a sign of the top, and he's a good long-term investor. Next, you talk about target prices. Well, it's different for different types of investors. The typical Wall Street guy just issues a target because, their report is not so much a research report as a marketing piece. It's just something that they use to get other kinds of business from people. But They're always, heavily long biased, which I guess makes sense, right? We all should be, because that's what happens over time. But to a Wall Street guy, what they typically do is they do, some fundamental gymnastics, and then they say, it's trading for this multiple of earnings, and we think it should be this multiple of earnings, and that's our target price. And that's how they establish that. I didn't look at the SocGen report that I mentioned in the news today that they put out about Ferrari when they mentioned Tesla, Ferrari being 12 times more valuable than Tesla. I assume it's that kind of a thing. Okay, so there's that. Then there is value investors say, well, I think the intrinsic value of a company is X and it's at a 50% discount, so maybe I'll sell it when it's X or at a premium to X. And so that's another way of thinking about target price. And another way is, you said, irrespective of companies' fundamentals or stock's technical performance, I have no idea. I've never heard of a target price irrespective of those things. Okay. And so the other kind of target price is technical. We think it's going to retrace a Fibonacci move or something, whatever kind of thing they do, and hit a certain price, and then we're out. So I hope that helps. And our last one this week is from Gary S. And Gary S. just has a couple comments. And first, he has a quote from someone named Idris Shah. And I didn't look up Idris Shah. I don't know who that is. I need to look that up. And the quote is, "A pessimist is just an optimist with extra information," which I found cute and insightful and interesting. It sounds like it belongs in Ambrose Bierce. Then he says, if people want smoke blown up their hoo-ha, there are actually places that will do that, and for much less money than the stock market. Thanks for all you do, Dan Ferris, our virtual optometrist. So I think he's kind of calling me the optometrist. Maybe he's telling me I'm helping you see things clearer. I hope so. But, when you say smoke blown, in the military, they used to say, when someone's blowing smoke up your hoo-ha, they're giving you a hard time. When they're, telling you good things, they're blowing sunshine. But I've heard this blowing smoke thing to mean sunshine, not smoke, a few times now. So people, they don't say sunshine, they just say smoke instead. So smoke and sunshine have been reversed. I don't know how that happened. But thank you, Gary S. I appreciate the kudos and thank you for listening. And thank you, Brian B. too, for sending in some email and being a long-time listener, it said in his email. So, remember, feedback@investorhour.com, okay? That is another episode on the books for Stansberry Investor Hour. Check out our website. You can get all the episodes, every episode from the very beginning, and you can see show transcripts of every episode, and you can enter your email address to make sure you get all the updates on every episode. So just go to that same address, investorhour.com. It's my privilege to come to you every week. Thank you so much for listening. I will talk to you next time. Bye-bye.
Thank you for listening to the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email at feedback@investorhour.com. This broadcast is provided for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.